All right. Here we have the position. We're talking about Boeing, and Boeing's got this setup that we can see has been in a pattern that's repeating at a certain frequency. In fact, okay. So frequency is 1/time. So time is always more important than price, but the frequency is very, very clear. Like you can see the periodic, the motion of the waves, right? And what I want to do here is explain that this type of trade setup is the same setup where Boeing has made an average move of around 30%, right? And you might, no, come on, Roger, don't be like that. And I was like, no, seriously, it's made like 40% moves off this 2D aggregation period, TTM squeeze. Actually, the one where the market crashed, which was a 4 standard deviation move, it crashed 73% in 34 days. And then that was off the first 2D wave. And then on the second 2D trigger, it moved up 105% in 22 days. And then the other one with the Wolf Wave 5, it moved up on the initial leg up 55%. So actually my averaging is wrong. I think the average is around 75% move on average. So then does that mean that this next TTM squeeze is going to exhibit a 75% move higher? So from where we are in the next like 20 days. So from here to here, is that going to be 75%? 75% is like up to like $300. Well, I don't know that, and I'm not going to be entertaining that idea, but we can kind of model our risk so that we can try to get a good chunk of that pie. So what we got to do is we got to position size. So based on the previous price action and the TTM squeeze on the 2D aggregation period, we know that this moves a significant amount. And we know that it works after the past, looking at it at point number 1, 2, 3, on 3 attempts. So on the 4th attempt, will it do the same thing? Okay, and now we're stuck at this squeeze at here. That's representing pure 50-50, slightly 51%, because we're going to assume that it's going to be doing the same thing that it did previously. So when we want to determine the probability of success in this type of setup, then you use this Kelly criterion calculator, which is here. I just posted in the Discord channel. This is from Pinnacle. And this is Pinnacle is a sports betting website, okay? And you're like, Roger, what does sports betting have to do with any of this stuff? And I said, well, I just listen, okay? And then, so Kelly criterion is a risk management tool to determine position sizing as a function of probability of success. And what you need to do is you need to understand that this is sports betting risk management. So this is pure binary. The team wins or loses, you lose money or win money, straight up. With options, it's a little bit different because if you catch the trend, then you're not likely to lose money. You're just kind of waiting for time to develop and then fighting off the decay. So it's not as brutal as a team that loses, on your bet. Okay, it's not binary. It's not like you're gonna lose instantaneous money unless the plane crashes, right? Boeing plane crashes. Actually these days when the Boeing plane crashes, it's actually not even the stock price is not even moving anymore. But anyways, when you have like your setup and you've identified a repeatable pattern, and you're gonna assume that it's gonna happen again in the future, because that's what humans do, right? Because this is a man-made market. It's not like Mother Nature or like Texas. I think Texas got like a snowstorm. Nobody knew that was going to happen, right? It's not predictable, but the market is at some degree. So by assuming whatever has happened in the past can happen in the future, we're going to say the probability of success for this specific trade is going to be around 51%, because 50% by definition is random, right? It's like flipping a coin. Nobody knows. But you can have like a series of heads 10 consecutive times. But in this case, we're going to have a biased coin where we're going to assume 51% that Boeing is going to move higher. Okay. And then in terms of decimal odds, we are going to assume, like you just look at the option chain and say, okay, well, if I buy the 222.5s and it goes to $4, then that's going to be like a profit factor, decimal odds of like of 5.0. So then when you put in 5.0 here, then you can see that Kelly criterion saying, hey, you need to put in 38% of your net liquid. So that might be just a little bit too high, right? So there's obviously something wrong with this approach. Like 38% is a very, very big position. So instead of like thinking about putting in the decimal odds at 5.0, why not just manage, like pick a conservative number where you've seen this cycle play out and you've seen the returns on that time cycle 1, and just use that value and input it into the decimal odds parameter input value box. So let's use 100%. So at 100%, you pretty much get back all your entire initial position. You can close it off and get all your money back, and whatever is left in the market is your profit, right? So then here with 100% return at 51%, it's Kelly criterion is telling you to put in 2% of your net liquid. Now 2% might be really, really small, okay, depending on how big your account is, and maybe that's not enough for what you think it is, acceptable for this, because you're assuming 51%. So it's either the decimal odds is incorrectly inputted, or the probability of success. So normally people who are like in hindsight means 100%, right? So in hindsight, after we put in, we make the trade and we make 100%, then in hindsight, then Kelly criterion says you should put 100% of your net liquid. You should literally go all in, right? But yeah, it doesn't work like that, because that's called hindsight analysis, and and that's why you get that feeling. It's like, oh shucks, I should have put in more money into that position, right? So that's what this is what the math is saying. So when you think about it psychologically, it's like, oh, in hindsight, 100%. Oh, I should have put in 100% of my net liquid, because it made money for me today. But we're not talking about today. We're talking about the now. So now we don't know, because we have uncertainty in the markets, right? So all we can do is make an assumption, but an assumption is not hindsight. So what is our assumption? Well, our assumption is, first of all, 50%, because it's purely random, and we have to fight against decay. And then we'll add another 1% just for personal bias. And then we add another, like a factor, a multiple of maybe like another 4%, brings up to 55%. Okay. Now you can, depending on the probability of success, like here, it did have success on the first trigger, and then it failed here. So I would say that didn't work out for the bulls, but it did work out. And then this one is it worked out to the upside, and then this one worked out for the upside, and a whole bunch of uncertainty here that was just kind of scanning, and you didn't know when it was going to trigger. But that's not part of the trade, right? But it is something that you had to figure out if this was going to trigger to the upside. And actually, we were trading in here with 50% probability, and we could be in that same situation where we don't know if this is going to trigger. But based on the histogram here, you can see it's right at the 0 line, about to make the new positive histogram, the cyan colored histogram above the 0 line that would push the price higher. So is this really a setup that's 50-50? No. Is it a setup that's 51%? Conservatively, yes. Now you have to figure out whether you want to apply an additional 4% and how much higher you're going to add. So you can't add 100% because you don't know. Okay? That's just, there's no such thing as you just have to get that through your head. There's nothing that's 100%. So at best it's 99%. Okay, so 98%, but that's still like not even in the option chain, the highest probability of success goes up to like 98%. So I think in general, when you're looking for some probability that you want to work with, then you would have to go back and see how many times this TTM squeeze worked for you. And based on my calculation, it's got actually 58%. So where did I get that number of 58%? Well, it's actually documented in one of the learning curves on day, which day was it? Was it day number 1? Day number 6, 7? Yeah, day number 7 here. So if you take a look at this, the probabilities here, I'll post it there. It's 57%. So the probability of success is around 81 to 57. So that's around 63. But let's just say, let's take the lower range. That's 57. So 57.14. So that takes you up to 14. So 14% is the amount that Kelly Criterion is recommending for 100% return. And then at 100% return, you close off half the position, so you get your initial investment back, and then whatever you ride higher, then you let ride higher. Now, a staggered position is important because you want to get the staggered position in place now, because you don't want to be buying that staggered position when prices already moved up, 5% on Monday. You want to get in now and then deal with the potential stress now, and then deal with it, over the weekend. You don't want to be chasing it on Monday and Tuesday unless it pulls back. So you in theory, we should have had about 14% in it now. But again, we don't know what's going to happen on Monday. So I've taken a 5.5%. So that would take me down to about 53% probability. Okay, so I have about 53% probability that I've injected here that for this Boeing setup. PG. So PG, okay, so I finished this tutorial and that's done.